Hi guys. Today we will analyze Johnson & Johnson stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. In the last year, Johnson & Johnson was a good performer. The long-term trend is positive and the short-term trend is neutral. Support level is around $159. The next support level is around $155. Resistance level is around $171. Strong resistance level is around $175. In the last month the stock has been trading between $159 and $173 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 8 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 5% per year, for last 5 years. We see that the average profit margin of the stock has been around 16% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 97% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Johnson & Johnson Company: bad, average, and good. First scenario. Johnson & Johnson will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 2%. Future profit margin would be a low, 10%. Future free cash flow to net income rate would be a low, 90%. In this case, the fair value of the stock today would be $98. The second scenario. Johnson & Johnson will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 13%. Future free cash flow to net income rate would be average, 100%. In this case, the fair value of the stock today would be $145. The third scenario. Johnson & Johnson will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 16%. Future free cash flow to net income rate would be high, 110%. In this case, the fair value of the stock today would be $207. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 7.81. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Johnson & Johnson, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 20. Again, I will use 3 different scenarios for Johnson & Johnson Company: bad, average, and good. First scenario. Johnson & Johnson will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 2%. Future P/E would be a low, 18. In this case, the fair value of the stock today would be $61. Second scenario. Johnson & Johnson will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future P/E would be average, 20. In this case, the fair value of the stock today would be $80. Third scenario. Johnson & Johnson will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 22. In this case, the fair value of the stock today would be $105. As you can see, today the stock is overvalued, $169, even if we expect the company's high performance in future. The revenue will grow by 6% on average per year in the next 5 years. While showing a small growth rate, the stock is a little bit expensive at the moment for me. I would be happy to buy the stock at $145. Company strengths. Johnson & Johnson is a diversified healthcare company that develops, manufactures and markets products in 3 primary lines of business: pharmaceuticals, medical devices, and diagnostics, and consumer products. The pending spin-off of the consumer health business, which generated $14.6 billion in sales in 2021, is on track for completion in 2022. The separation of the consumer health business from J&J will help each company to allocate capital more efficiently. J&J's pharma segment continues to offer a promising outlook due to strong prospects on existing key drugs such as Stelara, plus a robust drug pipeline with 14 novel drug launches expected by end 2023. Compared to peers, J&J has a solid balance sheet with low debt and total cash around $31 billion as of year-end 2021, providing ample financial flexibility. J&J's return on assets of 10% and return on equity of 25% are amongst the best returns of the industry. Profit margin of 22% is amongst the best returns of the industry. Risks. The company faces a range of competitive, regulatory, and legal risks. On the pharmaceutical side, its competitors include both established manufacturers of branded drugs and biologics as well as suppliers of generics. In addition, the company faces significant costs in developing prescription drugs, which typically have lengthy development cycles. J&J also faces pricing pressures from insurance companies and regulatory agencies in overseas markets. Additional risks include new waves of COVID-19 infections resulting from the newly discovered variants, creating renewed uncertainty and negatively affecting earnings, as well as R&D pipeline failures, increased pressure on drug pricing, and adverse legal judgments. The revenue is expected to grow by 6% on average over the next 5 years. The EPS growth is decreasing. In the next 5 years the growth will be less than in the last years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.